Welcome back to Talk Tickers. It is Friday, February 13th, 2026.
Ooh, spooky.
Look, I really hope you aren't superstitious. I mean, I really do. Because if you are, the set of numbers we are about to tear apart might just give you nightmares.
Yeah, they might.
Or maybe, just maybe, they're the kind of nightmares that, turn into dreams if you just wait until the market closes.
That's a good way to put it.
We are looking at the one, the only, the constantly controversial Coinbase. Ticker symbol COIN. We are breaking down their fourth quarter and full year 2025 earnings call, which happened just yesterday evening.
That's right. And if you were watching the tape yesterday around, 5:30 p.m. Eastern, right as the closing bell was echoing out, you probably got a severe case of financial whiplash.
Whiplash is putting it mildly. I think I might need a neck brace after watching that price action.
It was wild.
We're talking about a quarter defined by a headline number that if you just glanced at it on your terminal or, on your phone notification, looked absolutely disastrous.
Yeah, catastrophic.
It looked like the company had literally set a giant pile of money on fire. But then you look at the after hours action and the stock is actually rallying.
Right.
It's a classic case of what we like to call the miss that wasn't.
It really is. And the setup here is so crucial because context is just everything in this market, isn't it?
It is.
We have to set the scene for where the market was right before this print dropped. We are in February 2026, and let's be honest about the vibe.
The vibe is nervous.
Nervous is a good word. Bitcoin has come down materially from those highs we saw back in October 2025. I mean, it feels like a lifetime ago, doesn't it?
It really, really does. That euphoria from late 25 feels very distant right now.
Exactly. So the general sentiment across all the crypto venues has been one of volume compression.
That's the polite way to say it.
It is the polite institutional way of saying people just stopped trading as much. The tourists went home.
Right. The crypto winter 2.0 whispers have been getting louder and louder. You see it on Twitter. You see it in the newsletters. People are asking if the cycle is dead.
So with that backdrop, the stock was already pressured going into the close yesterday. It dumped on the headline print initially, and that was pure algorithmic selling, machines just reading the ugly top-line number and hitting sell.
Of course.
But then, as the smart money, the humans, started actually reading the shareholder letter, parsing the footnotes, and listening to the call, we saw this rebound.
And it was a sharp one.
It climbed back up about 2.8%, maybe 3.0% in after-hours trading, hovering right around that $145 mark.
So the thesis we are exploring today is pretty specific then. It seems like the market is finally trading the transition, not just the transaction volume.
Yes.
Investors are seemingly willing to look past some pretty severe mark-to-market pain to buy into this everything exchange thesis that Brian Armstrong and his team have been pitching for what feels like years now.
That is the core conflict of this whole story. It's the everything exchange vision versus the GAAP accounting miss. And believe me, that GAAP miss was ugly.
Oh, it was brutal.
It was the kind of number that makes you double-check your screen just to make sure you didn't misread a decimal point.
Okay, let's unpack this. Let's get into the ugly part first. Because when I saw the notification flash, I genuinely did a double take. The headline, GAAP earnings per share, or EPS, came in at a loss of $2.49.
Negative $2.49 per share.
And just for context, the consensus expectation from all the analysts who are paid millions of dollars to predict these things was looking for a loss of maybe 5 cents?
5 cents, yeah. Negative 0.05 cents.
A rounding error, essentially.
Basically, they were expecting a flat quarter.
So they missed by nearly $2.50. In the world of, traditional finance, if you are running a soup company or a car manufacturer and you miss by that magnitude...
Well, it's over.
The board meets immediately, and you are usually escorted out of the building by security before the sun even comes up.
Usually, yes. But this is where you have to put on your forensic accountant hat. You have to be a detective here. This delta, this massive gap between expectation and reality, it wasn't an operating blowout.
Right.
They didn't lose that money running the business. They didn't, accidentally buy a fleet of private jets or lose the keys to the vault. It was almost entirely accounting volatility.
This is the dreaded paper marks issue. We talk about this a lot, but I want to really drill down into it because it confuses so many people.
It creates so much noise. So here is the breakdown. We're looking at a $718 million unrealized loss on their crypto investment portfolio.
Okay, $718 million.
Plus another $395 million loss on strategic investments, which includes their big stake in Circle.
Right.
Now remember, the key words here are non-cash, market-driven marks.
Okay, stop there. Non-cash, market-driven marks. Explain that like I am 5 years old, or maybe. Like I am a sophisticated 5-year-old with a really successful lemonade stand.
Yeah, okay. The lemonade stand. Imagine your lemonade stand also happens to own a rare Pokemon card.
Got it. A Charizard, first edition.
Perfect. You bought it for $100. In October, the card was suddenly worth $200. You felt rich, but you didn't sell it. You just kept it in the safe.
Right, I'm a holder.
By December 31st, the market for Pokemon cards crashed. And that same card is now worth only $80.
Okay, I'm sad.
You're sad, but you haven't actually lost any cash, right? You still have the card. Now, under standard accounting rules for most assets, you just hold it at what you paid for it. But for crypto assets, under the current FASB fair value rules, it's different.
How so?
You have to mark that card to the market price at the exact second the quarter ends.
Exact second.
Exact second. So because the price dropped between October and December, you have to report a loss on your income statement, even though you still have the card and you never sold it.
So you didn't lose any cash from your lemonade register?
Zero cash. But the rules say you lost money on paper.
So it's a snapshot. It's like taking a selfie of your net worth on a bad hair day and then being legally required to publish it in the newspaper.
That is a perfect analogy. It is a mandatory bad hair day selfie.
Yeah.
And because Coinbase holds a massive amount of crypto on their own balance sheet, not customer funds, I mean their own corporate treasury, when crypto prices dip like they did in Q4, the value of those assets goes down on paper. And they have to eat that loss in the EPS number.
So just to be crystal clear, if Bitcoin had a massive, unexpected rally in the last hour of trading on December 31st,
This whole story flips.
the earnings report would look totally different.
Completely different. They might have posted a massive profit.
Yeah.
And that is exactly why the smart money looks through it. It introduces this insane volatility into the P&L that has zero correlation to the actual operating health of the business. It's noise.
So it's a paper wound. It looks like a gaping chest wound on the earnings sheet. But in terms of cash, the patient is, walking around and feeling just fine.
They are more than fine. They are actually thriving, which leads us to the good part of the report, the operating reality.
Let's hear it.
If you strip away those paper losses, if you just delete the bad selfie, the revenue was $1.78 billion.
Okay. And the street was at what, 175?
Yeah, $1.75 billion consensus. So it's roughly in line, maybe a slight miss, but it's holding steady in a tough market.
And the really important number, the adjusted EBITDA.
$566 million.
566. That is a healthy number.
This is a very healthy number.
But I want to push back on this a little bit. You say it's healthy, and look, $566 million is a lot of money, no doubt. But I'm looking at the top line trends here.
Okay.
Transaction revenue, that was $983 million. That's down 6% quarter over quarter. And then subscription and services revenue, that was $727 million, down 3% quarter over quarter.
Both down, you're right.
Both are down. So growth wasn't exactly exploding in Q4. If you are generating EBITDA just by cutting costs while your revenue is shrinking, isn't that a bit of a red flag? Isn't that just, managing a decline efficiently?
That is the bearish take, and it is a completely valid one. If you believe we are in a secular decline for crypto, then yes, they are just managing the slow death of the business very, very efficiently.
Right.
But the counter argument, and this is clearly what the bulls are betting on, is that this is cyclical softness. We're in a volume compression cycle. In that kind of environment, the fact that they can still print over $500 million in EBITDA is a testament to their discipline.
It's the year of efficiency that just never ended for them.
Exactly. And here's the stat that really matters to me. This is the 12th consecutive quarter of adjusted profitability.
12 straight quarters.
So regardless of the crypto winter vibes, regardless of Bitcoin retracing from its October highs, Coinbase, as an operating business, is printing cash. They aren't burning furniture to stay warm anymore. They have a furnace.
That's a resilience streak that I think gets overlooked when people just obsess over the day-to-day price of Bitcoin.
Totally.
But let's go back to that revenue mix for a second, because it tells a story about that transition we mentioned at the top. Transaction revenue is down. That's the trading fees. That's the casino part of the business.
Right. And for years, that was the only part of the business that mattered.
Exactly. But subscription and services, that includes things like custody, staking, stablecoin revenue, that is down slightly too, yes, but it's becoming a massive chunk of the pie. It's almost, 45% of the total business now?
That is the shift from casino to utility. That's the whole thesis. They want that recurring revenue to buffer the crazy volatility of the trading fees.
It was a soft quarter.
Yeah, there's no getting around that. It was.
But the synthesis here, and the reason the stock bounced, is that the buy side is valuing the cash generation. They have $11.3 billion in cash and cash equivalents on the balance sheet.
$11.3 billion. That is a fortress balance sheet.
It's a war chest.
It is. And they're being incredibly aggressive buying back their own stock. The market looked at that $2.49 paper loss and just said, we don't care. That's accounting noise. Show me the cash.
And show me the future, because that cash pile is what funds the big pivot.
Yeah.
And that is where I want to spend the bulk of our time today, the strategy shift.
Yes.
Brian Armstrong was incredibly bullish on the call, specifically about this concept of the everything exchange. It sounds like a marketing slogan, but they seem dead serious about it this time.
It is the biggest thematic shift in the company's entire history. Yeah. For a decade, Coinbase was a crypto exchange. Full stop. You went there to buy Bitcoin, maybe some Ethereum, maybe some Dogecoin if you were feeling lucky.
Right.
That was it. The vision now is moving completely away from pure crypto spot beta. They want to be the single platform for all tradable assets.
All tradable assets, that's a very big claim.
It's a massive claim, but look at what they're actually doing. They're rolling it out.
Yeah.
Management explicitly mentioned on the call that they are scaling up to 10,000 equity tickers this month.
Okay, pause right there. 10,000 tickers. That's basically the entire U.S. stock market.
It is. It's everything.
So they are putting themselves in direct competition with the likes of Robinhood, Schwab, Fidelity.
Head to head.
But why would I do that? Seriously, if I have a Schwab account, it works great. Why would I buy my Apple stock on Coinbase?
Friction, or rather the elimination of friction. It's the flywheel effect they keep talking about.
Explain that.
It starts with trust. You trust Coinbase to store your crypto assets because, let's face it, they haven't been hacked. They haven't rug pulled anyone. They're a public company in the U.S. They're the adults in the room.
Right, they aren't FTX.
God, no. They're the anti-FTX. So that asset storage leads to cross-selling. If your money is already there for Bitcoin, maybe you sold some Bitcoin and you have $50,000 in USDC just sitting there.
Okay.
Why would you transfer it back to your bank, wait 3 days for it to clear, send it over to Schwab, wait another day, just to buy some Apple stock? Why not just click one button and buy Apple right there on Coinbase?
It creates a walled garden of finance?
Yeah.
A true super app.
Precisely. And it's not just stocks. They mentioned commodities, gold and silver futures.
Which was a fascinating little detail to me. They noted that gold and silver futures actually drove record notional volume on the exchange while crypto was slumping.
That is the diversification thesis in action. That is the holy grail for them. When crypto zigs, maybe gold zags.
Right.
If people are scared of Bitcoin because it's crashing, maybe they run to gold for safety. If Coinbase owns both casinos, they capture the fee either way. They don't care what you trade as long as you trade it on their rails.
And then you have the new darling of both the degenerate gambler and the sophisticated hedger alike, prediction markets.
Yes, this is huge. They rolled this out to 100% of customers a few weeks ago. They specifically mentioned the Super Bowl as a major onboarding event for that product.
I saw it.
And they're building dedicated sports hubs.
This feels like they are trying to capture that polymarket energy, which just blew up during the last election,
right? But
within a fully regulated U.S.-based wrapper.
That's exactly what it is. Polymarket is great, but it has all these regulatory headaches in the U.S. Coinbase is saying, we can do this legally. We could do this cleanly. And prediction markets are so fascinating because they're completely uncorrelated to the stock market.
Right. Who wins the Super Bowl has absolutely nothing to do with what the S&P 500 does that day.
Zero. So again, it's all about decoupling the business from the crypto cycle.
Yes. But we have to talk about the acquisition that's really powering a lot of this more sophisticated trading. The elephant in the room. This was the largest acquisition in their history. And it is now fully feeding into their derivatives growth.
It's a good game changer for them.
So why is that so critical? For the listener who maybe doesn't trade options, why does owning Deribit matter so much for Coinbase's bottom line?
It's because options are where the real money is made. Well, not just the real money, the sticky money.
Sticky money.
Yeah. Spot trading, buying one Bitcoin and holding it is a low velocity activity.
Yeah.
You buy it, you sit on it for 3 years, Coinbase gets one fee from you.
Yeah.
Options and derivatives are high-velocity, high-margin products. Institutional investors need them to hedge. If you're a massive fund holding $1 billion of Bitcoin, you need to be able to buy put options to protect your downside.
You have to.
And active traders use them for leverage. By integrating Deribit, Coinbase isn't just selling the asset anymore. They are selling the risk management of the asset.
Ah, that's a good distinction.
Options market share is a key growth vector for 2026 because it keeps the users on the platform every single day, adjusting their positions, rolling their contracts. It makes the whole platform stickier.
So they are building a financial super app that caters to everyone from the guy buying $50 of Bitcoin for the first time to the most sophisticated hedge fund managing a billion-dollar position.
That's the goal.
But there is another layer to this onion, and it's the one that sounds the most sci-fi. Honestly, when I heard this part of the call, I thought I was listening to a pitch for a cyberpunk novel.
I know exactly what you're talking about.
We need to talk about the on-chain economy, and specifically the intersection with AI.
This was the part of the call where I sat up straighter in my chair. I stopped taking notes and I just listened. Brian Armstrong and the team are positioning their layer 2 network,
Right.
not just as a scaling solution for Ethereum, but as the on-chain home for AI agents.
The on-chain home for AI agents, that is a sentence that would have sounded like absolute gibberish 3 years ago. What does that actually mean in plain English?
It means they are betting on a fundamental shift in who or what participates in our economy. Look at the metric they dropped. It was a bombshell.
What was it?
Based at a new transaction all-time high in Q4. And what drove it? Was it people buying NFTs of monkeys? Was it a new meme coin? No.
Yeah.
It was AI agents adopting stablecoin wallets.
So just to be clear, we are not talking about humans clicking buy. We are talking about software programs, autonomous agents, executing transactions on a blockchain.
Exactly.
But let's pause on this whole AI agent thing, because to a lot of people, that sounds like sci-fi fluff used to pump the stock.
I get that.
Why does a software program need a crypto wallet? Why can't it just use a corporate credit card? If I have a bot that needs to buy server space on AWS, I just give it my Amex number, right?
Try getting a credit card for a piece of code. I mean, seriously. Go to JP Morgan or Wells Fargo and say, hi, I have a Python script. It's running on a server in the cloud. It's autonomous. It needs to spend $5,000 a month on API credits and various data sources.
They would laugh you out of the building.
They will ask for a social security number.
Yep.
They will ask for a physical address. They will ask for a driver's license. They will ask for a human owner to personally guarantee the debt. The entire KYC or Know Your Customer regulatory framework is built for biological humans.
Right. The legacy banking system is built on human identity.
And crypto is built on keys.
Right.
If you have the private key, you have the money. An AI agent can generate a new wallet address in milliseconds, get it funded, and start paying for server space without asking permission from a bank manager in another time zone. It is permissionless.
So Coinbase isn't just betting on AI. They're betting that AI will be fundamentally unbanked by the traditional system.
That is the entire thesis,
Yeah.
correct? And Base, their layer 2 blockchain, becomes the path of least resistance for these agents. It's fast, it's incredibly cheap. We're talking sub-cent transactions, and it doesn't care if you're a human or a bot.
And this connects directly to the stablecoin thesis, right?
Perfectly.
We know that USDC balances hit all-time highs in Q4, but the narrative shift here is what's fascinating. They're moving from stablecoins being just a trading pair. You know, I sell Bitcoin to sit in USDC for a while to de-risk to being all about utility.
The friction in the market cap has been real, though. We have to acknowledge that. We saw the USDC market cap flatline recently.
Which is usually a bearish signal.
It is. It usually means there's a lack of risk on leverage in the system. People aren't borrowing stablecoins to buy more crypto.
But there's always a but.
But the velocity and payments volume are up.
Okay, so the total amount of money isn't growing, but the movement of that money is accelerating.
Precisely. And that fits the AI agent narrative perfectly. An AI agent doesn't need to hoard $1 million in a savings account.
No.
It needs to move 5 cents here, $10 there, instantly, 247 across borders to pay for compute, to pay for data, to pay for API access. It needs flow, not storage.
That is the machine economy, and Coinbase is positioning itself as the toll booth for that entire economy.
Exactly. They get direct monetization through sequencer fees on Base. Every single time that bot makes a transaction, Coinbase gets a tiny sliver of a penny. And they get indirect monetization through the broader usage of USDC.
It's a really compelling story, especially if the crypto market for humans remains choppy. The robots don't get scared of crypto winter.
The robots don't have emotions, they just execute code.
Speaking of choppy, let's look at how they're managing their own war chest through all this. The capital allocation section of the call was, well, it was aggressive.
It was a defense of the stock price, plain and simple. They came out swinging.
They really did.
They repurchased $1.7 billion recently. That effectively offset all the dilution from their stock-based compensation for 2025.
Which is something investors have complained about for years and years. Stop diluting us with stock options. Crypto companies are notorious for paying everyone in stock, and they finally just said, okay, fine, we'll buy it all back from the market.
And they are not stopping. The board approved another $2 billion in buyback authorization. This is management signaling very, very loudly, we think our stock is cheap.
They're buying the dip alongside retail investors.
They are.
However, they did pair that bullish action with some pretty serious caution on the guidance front. We have to be realistic about Q1 2026. The guidance wasn't exactly a party.
No, the guidance was definitely not a blowout. They guided Q1 subscription and services revenue to a range of $550 million to $630 million.
Which is a big step down.
It's a significant step down from the $727 million they just posted in Q4.
That's almost a $100 million drop at the midpoint of the range. That is a massive chunk of recurring revenue just vanishing. What's driving that?
They said there are headwinds on three main fronts. First, lower average crypto prices. If the assets they hold in custody are worth less, then the custody fees, which are a percentage of those assets, go down.
Makes sense.
Second, lower staking rewards. The yields on things like Ethereum staking have compressed as more and more people have piled into stake.
The easy money is gone.
It's getting harder. And the third one is a big macro one. Lower interest rates. Remember, the macro environment is shifting. Coinbase earns a massive amount of money on the interest from the reserves backing USDC. They hold short-term treasury bills. If the Fed cuts rates, as many expect, that interest income drops straight to the bottom line.
So the passive income engine that's been so powerful for them is sputtering a little bit. That free money glitch from high interest rates is fading away.
It is. But, to their credit, they are matching that revenue headwind with extreme expense discipline. Tech and admin expenses were guided flat. At $925 million to $975 million. They are holding the line on costs even while they are rolling out 10,000 equity tickers and integrating the entire Deribit platform.
That is what you call operating leverage.
It is. It's the mature tech company playbook. We will grow the product, but we will not blow the budget doing it.
Okay, I want to zoom out now to the investor context, because a lot of the bullishness on the call, specifically from Brian, seemed to be tied not to tech, but to the political landscape in D.C.
The regulatory clarity call?
Yeah.
Yes. Armstrong said he is more bullish than ever on policy.
He specifically mentioned the Clarity Act.
Right, and his optimism is that this passes within the next few months.
Which seems aggressive given the pace of Congress. I mean, have you watched C-SPAN lately? They can't agree on lunch?
It is optimistic. But let's assume he's right for a moment. What is the actual impact? Why should an investor care if the Clarity Act passes?
That's the question.
The big one is that it would secure the ability for U.S.-regulated stablecoins to pay rewards to holders. This is crucial.
Why?
Right now, if you hold an offshore, unregulated stablecoin, maybe you can get some kind of yield. If you hold a U.S. one like USDC, it's legally much trickier. If the Clarity Act passes and explicitly allows this, it levels the playing field against all those unregulated offshore entities. It brings the capital back onshore.
There is a really interesting moment in the Q&A regarding the circle economics. Management said something that felt a bit like 4D chess.
I remember this.
It was one of those moments where you realize they are thinking 3 moves ahead of everyone else.
It was a great piece of nuance. They were asked if legislation that eliminated promotional payments would hurt them. Basically, if the government said, you cannot pay people yield to hold stablecoins.
Right, which sounds like it would be bad for business.
You'd think so. But they said, ironically, it would make Coinbase more profitable.
Explain that logic to me, because that sounds completely backward. Usually banning a feature is bad for business.
Okay, so right now, Coinbase receives income from Circle, the issuer of USDC, based on the reserves. Coinbase then passes a lot of that income onto the customer as rewards, essentially paying you to hold USDC on their platform.
Okay, it's a customer acquisition cost.
Exactly. If the government bans those payments to customers, Coinbase still gets the money from Circle for the reserves. They just don't have to or aren't allowed to give it to you anymore. So their margins on USDC instantly jump up.
So they get to keep the whole pie, but But they still oppose that legislation.
They oppose it because it hurts the U.S. competitive stance. If U.S. stablecoins can't pay yield, global money will just flow to offshore stablecoins that do.
Ah.
So Coinbase is taking the long view here. They're saying, let us pay the customer so the entire ecosystem grows, rather than let us keep the profit this quarter and watch the ecosystem shrink over time.
That is smart. It's prioritizing the size of the network over the margin of the quarter.
Very smart.
Now, let's talk about the market structure signals they mentioned. We talked about volume compression. Who is actually trading right now? Is it just the bots?
Retail is behaving very interestingly. The data shows they are hodling.
Hodling?
Yes. The on-chain data shows retail is not selling in a panic. They are actually net buyers on the dip. But the volume is low. They aren't day trading. They're accumulating.
So they're treating it like a savings account, not a slot machine.
Exactly. It's a different kind of user behavior than we saw in past cycles.
The winter debate is still raging, of course. Management refused to call it a winter, obviously.
They never do. They just say they build better in down markets. But here is the real counterpoint, and this is what the bulls are hanging their hats on. The disconnect between the Bitcoin price action and the everything exchange volume.
Mm-hmm.
It suggests that the correlation break is finally starting to happen.
What do you mean?
If commodities and equities volumes are growing while crypto volume is down, that is the holy grail for this stock. They want to decouple from the price of Bitcoin.
They want to be a fintech infrastructure play, not a Bitcoin proxy. They want to trade like Visa or the CME group, not like a Bitcoin miner.
Exactly. And if they can pull that off, the multiple on this stock expands massively.
Before we move on, we have to address the glitch.
The elephant in the server room.
Yes. There was a recent outage and interruption. Management defended it, saying it was purely technical, not liquidity related. And they emphasized that the equities and derivatives platforms remained unaffected.
Which is good. It wasn't a solvency issue or a bank run. But here is the big investor takeaway from that. As they become a super app, as they try to be the everything exchange, uptime reliability isn't just a nice to have anymore. It is a systemic risk factor.
If I can't access my money, I don't care why. I just care that I can't get it.
Exactly. And think about the AI agents. If you are the on-chain home for AI agents and the home for spot crypto and the home for 10,000 stocks, and you go down...
The damage is exponential.
It is. If an AI agent tries to make a payment and fails, it switches providers instantly. It's not loyal. It just finds a rail that works.
Reliability becomes the entire product.
It absolutely does.
Okay, wow. We have covered the ugly JAP numbers, the strong underlying cash flow, the massive pivot to the everything exchange, and the rise of the AI agent economy. It is a lot to digest.
It's a complex story.
But now I want to transition to our favorite part of the show.
Oh, I know what time it is.
It is time for our This Is Not Financial Advice segment. This is where we pitch a wild but plausible trade based on the subtext of the call. We are looking for the alpha that isn't in the headlines.
And just to be extremely clear, this is strictly for entertainment. Do not do this at home. We're just idiots with microphones.
Speak for yourself, but yes, please do your own diligence. Okay, you're up. What is the pitch today?
Okay, I'm calling this one the machine economy ARB.
Machine economy ARB. Okay, I'm listening.
The trade is simple. You go long koi and you go short. Traditional payment processors. So think proxies for Visa, MasterCard, the legacy rails.
Whoa. Bold. Shorting the duopoly is usually a widowmaker trade. I mean, those companies are absolute money printers. Why now?
It goes back to Armstrong's commentary about Base being the on-chain home for AI agents. I think we need to take that more seriously than the market is.
Okay.
If 2026 is truly the year of the agentic web, where AI agents start doing actual economic work for us, booking our travel, buying their own API credits, hedging their own compute costs, they are not going to open a Wells Fargo checking account.
We established that. They can't pass KYC. They don't have a face.
Exactly. They have wallets. And they don't care about APR. They don't care about collecting points or airline miles. A robot does not need lounge access at the airport.
It doesn't care about the Chase Sapphire Reserve benefits, no.
It cares about subcent transaction speeds and programmatic access. It cares about code.
So the thesis is this. The fastest growing demographic of economic actors in the world isn't Gen Z. It isn't the emerging markets. It's AI.
Precisely. And in that scenario, Caoyan isn't just a crypto exchange anymore. It is the central bank for non-human economic actors. You aren't buying a Bitcoin proxy. You are buying the only piece of financial infrastructure that robots can use to pay each other at scale.
And if you short the legacy processors,
You are betting that the growth in transaction volume, the marginal transaction in the global economy, shifts from a human swiping a plastic card to a machine signing a cryptographic hash. You are betting that the future of payments is machine to machine, not human to merchant.
The kicker for me, the thing that makes this really plausible, is the prediction markets angle you mentioned earlier.
Yes, tie it all together. Imagine AI agents hedging their own compute costs via prediction markets on Coinbase.
What would that look like?
An AI says, I need to run a complex model next week. Energy prices might spike in that region, so I'll buy a contract on a Coinbase prediction market to hedge that risk.
Or I'm an AI managing a supply chain for a company. I predict a delay in shipping from this port based on satellite data. I will hedge that financial risk on the prediction market.
Exactly. If that starts to happen, the volume explosion on their platform decouples entirely from human sentiment. It doesn't matter if retail is sad about Bitcoin's price that day, the bots are trading because they have to. It becomes an industrial utility.
That is the trade. Long the robot central bank. Short the human plastic.
I love it. It's wild, it's plausible, and it's a little bit terrifying.
That's the sweet spot.
That really is.
All right, let's wrap this deep dive up. Can you recap the highlights for the listener who might have zoned out while we were talking about GAAP accounting rules?
Of course. Point one, look past the $2.49 GAAP loss. It's noise. Focus on the $566 million in EBITDA. The cash generation is real.
Point two, the everything exchange is live. This isn't just a slide deck anymore. Equities, derivatives, prediction markets are all rolling out. They are attacking the traditional brokers head on.
Point three, regulatory clarity is the next major catalyst. Keep an eye on Washington for the Clarity Act in the coming months.
And finally, point four.
Capital allocation is extremely shareholder-friendly. They are buying back their own stock aggressively.
So the final thought here is that Coinbase is attempting the hardest maneuver in all of fintech, transitioning from a cyclical casino into a structural, boring utility.
The Q4 numbers look messy on the surface, but the plumbing is being completely replaced underneath.
And if they pull it off, that $145 price tag might look very cheap in the rearview mirror.
Or we'll be at zero. It's crypto. Who knows?
That's the game we play. As always, this was not financial advice. Please do your own research on the insane risks of crypto volatility. It is a wild world out there.
It sure is.
Keep watching the ticker. We'll see you next time on Talk Tickers.
Bye, everyone.